Yes, welcome to this session where I want us to continue the topic of employees' benefits. And specifically, I want us to look on some few illustrations regarding how to account for the defined benefit plan. So we have two questions, the question for April 2022, question 3A, and also another question for May 2019, question 3A. So let's start with the question for April 2022, question 3A, and it reads, the following accounting information was extracted from the financial records of 𝐂𝐏𝐀 Limited regarding the defined retirement benefit scheme for its employees. So we are given a number of items there, starting with the net defined benefit obligation as at the start of the year, that is 1st January 2021. We have the net defined benefit obligation at the end of the year, the service cost, the contribution to the scheme, and the benefit paid to the trustee, paid by the trustee. So we are told the market yield of high corporate board is at the rate of 5%. And then in that case, we are told to assume no tax implication regarding the retirement benefit scheme. So then from there, what we are required to do is, with suitable calculations, explain the accounting treatment of the various items of the defined benefit scheme on the financial statements of 𝐂𝐏𝐀 Limited for the year which ended 31st of December 2021 in accordance with the International Accounting Standard number 19, employees benefits. Recall in our previous session, we talked about three items which must be computed and accounted for by the employer in relation to a defined benefit scheme. Number one is the net actuarial gain or loss on the net defined benefit obligation. Number two is the net pension cost. And number three is the net defined benefit obligation or asset. So therefore, these are the three items we are required to determine, or basically to compute, and also we explain how they should be accounted for by this particular company, and that is the 𝐂𝐏𝐀 Limited. So therefore, the items to be computed and recognized by this company, items to be computed and recognized by 𝐂𝐏𝐀 Limited. 𝐂𝐏𝐀 Limited include number one, we have the net actuarial gain or loss. Number two, we have the net pension cost. And number three, we have the net defined benefit obligation stroke asset. So these are the three items which 𝐂𝐏𝐀 Limited should compute and also recognize in the financial statement. So we start with the first one, and that is the net actuarial gain stroke loss on net defined benefit obligation. Net defined benefit obligation. So basically, in terms of how we compute this, it's also important to note that our figures are in millions of shillings. So we take into account, or basically we start with the net defined benefit obligation balance brought down. That is now the net defined benefit obligation as at the start of the year. And this is given at the paragraph 1, whereby you're told the net defined benefit obligation at the start of the year was 1850. So to this, we add the net interest cost. And the net interest cost, in our previous session, we said that this one is computed based on the market yield of high corporate board, and basically we multiply that with the net defined benefit obligation at the start of the year. So this will be 5% of 1850. So, and then to this, we will also add the current service cost. So the current service cost, in our case, this is given as a figure of 200. And then to this, we also add the past service cost if there was an improvement which occurred during the current financial year. And if you check on the information which is provided here, we don't have any past service cost. And then to this, we less the contribution which was paid by 𝐂𝐏𝐀 Limited to the retirement benefit scheme. And we're given that as a figure of 225. And after doing that, we will get something called the expected net defined benefit obligation at the end of the year. That is or the net defined benefit obligation at the end of the year. So let's work out this. We see what we get, and then automatically we compare that with the net defined benefit obligation as at the end of the year. But we first of all compute the net interest cost, which will be 5% of 1850, and this will give us 92.5. So we work out this. So we have 92.5 plus 1850 plus 200 minus 225, and this will give us a figure of 1917.5. So this is the expected net defined benefit obligation at the end of the year. So what we need to do is to compare this with the net defined benefit obligation at the end of the year. And this figure is given in our question as 2000. So basically what we do, we compare this with this. And if we have an increase from what we expected, or from or basically if here we have an increase from this figure to this one, because this essentially we said is a liability, an obligation is a liability, that should automatically be a loss. An increase, because anytime the value of liability increases is a loss, but a decrease should be what? A gain. And in our case, this is an increase from 1917.5 to 2000. That is an increase. That is an increase, and taking into account is an increase, or basically the value of the liability increased here. This is therefore a net actuarial loss, simply because an increase in the value of liabilities is a loss. Now, other than computing this, we are also required to explain how this should be accounted for by the employer, or basically by this company. And in our previous session, we say that this particular amount of net actuarial gain or loss in relation to the net defined benefit obligation is recognized as part of the other comprehensive income. So therefore, you can say the net actuarial loss of shillings 82.5 million should be recognized as part of other comprehensive income in the statement of comprehensive income. So therefore, this one is recognized as part of other comprehensive income in the statement of comprehensive income prepared by this particular company. So that is the first item which should be recognized by this particular company in its financial statement. The other one is the net pension cost. So the net pension cost. So to determine the net pension cost, we just add three items here. 3 items of expenses: the net interest cost, the current service cost, and the past service cost. Also, our figures here are in million of shillings. So the net interest cost, which is a figure of 92.5. Then we have the current service cost, which is a figure of 200. We also add the past service cost, but if any, in this particular question, we don't have any past service cost, so we get a figure of 292.5. So in our previous session, we said that this particular amount here should then be recognized as an expense in the income statement. So therefore, you can say the net pension cost of shillings 292.5 million should be recognized as an expense in the income statement of KIBO Limited. So the income statement, you have to recall, is the same with the statement of comprehensive income, statement of comprehensive income. So therefore, that's how we determine the net pension costs. And then the last item here we need to determine and also explain how it should be accounted for is the net defined benefit obligation or asset. So number 3, we have the net defined benefit obligation or asset at year end. That is on 31st of December 2021. And in our case, this figure is already computed for us, but in case this figure has not been computed, we always take the present value of defined benefit obligation, balance carried down, that is at the end of the year. So of which we don't have this. And then to this, we left the fair value of the plan assets still at the end of the year, and we don't have that. And whatever you get here is the net defined benefit obligation stroke what asset. And what you're given in this particular question here, because that figure has already been computed for us, we are given the net defined benefit obligation balance carried down, which is balance carried down is the balance at the end of the year, which is a figure of 2,000 million. So how should this be recognized in the financial statements? So this one is recognized as a non-current asset in the statement of financial position. So we can say the net defined benefit obligation balance carried down of shillings 2,000 million is recognized as a non-current liability in the statement of financial position. So therefore, those are the 3 items which the candidates were required to determine here, or basically to compute and also explain how should they be recognized in the financial statement of the of this particular company, which is the KIBO Limited, which was operating this defined benefit plan. So we are done with the first question here, the question for April 2022, question 3A. So I want us to proceed and look on this other question, the question for May 2019, which is question 3A. Also a question on accounting for the defined benefit plan. So the question reads, that is part A. That question has 2 parts. Actually, we have part Roman 1 and Roman 2. So in Roman 1, we are told with reference to International Accounting Standard number 19, employees benefit, briefly explain the accounting treatment of the net of the defined, that is defined benefit, pension surplus or plan asset in the financial statement of an employer. So we are required to explain the accounting treatment, of the defined benefit, pension surplus, stroke the plan asset, stroke the plan asset. So basically, a plan asset arises whereby the fair value of the plan asset which are owned by a retirement benefit scheme exceed or is more than the present value of the defined benefit obligation, either at the start of the year or at the end of the year. Now, this one is recognized in the statement of financial position of the employer as a non-current asset, So therefore, we can say that a plan asset is recognized as a non-current asset in the employer's statement of financial position. So we can also proceed and we explain how it is computed. We can say it is computed. Computed as follows. It is computed as follows. So to compute this, we take the present value of defined benefit obligation, balance carried down simply because the statement of financial position usually is prepared at the end of the year, and then to this we less the fair value of the plan asset, So in this case, once you get a negative figure here, meaning that this one is more than that, that is known as the net defined benefit asset. We are saying that this one should be recognized by the employer in the statement of financial position as one of the non-current assets. So that is it. That's what was required. So in Roman 2 of that particular question, we are told that W Limited, a public limited company, operates a defined benefit pension plan for its employees. The present value of the future benefit obligation as at 1st January 2018 was shillings 38 million, and the fair value of the plan asset as at the same date was 2860 million. So further information relating to the pension plan for the year which ended 31st of December 2018 was as follows. So we are given the current service cost, 209 million, benefit paid to former employees, 242 million, contribution paid into the plan, 259 million, present value of the benefit obligation at the end of the year, that is 360 million, fair value of the plan asset at the end of the year, 3113 million. Additional information, interest cost, that is the gross yield on blue chip corporate bonds, is 5%. And then number 2, we are told on 1st January 2018, that is now the start of the current year, the pension plan was amended to provide for enhanced benefit with effect from that date. The present value of the enhanced benefits on as at 1st January 2018 was calculated by actuaries as 110 million. So anytime you see that the pension plan was amended for the company to provide enhanced or better benefit, it basically means that the pension to be paid to the employees has been increased. And actually, in our previous session, we say that such an increase in the pension to be paid to the employees is a past service cost. So therefore, that figure of 110 million, this is the past service cost. So what are we required to do? The required note to the statement of financial, to the statement of comprehensive income and the statement of financial position to reflect the effect of the defined pension plan as at the end of 2018. So automatically in this case, we are required to determine or basically to compute the 3 items which must be recognized in the financial statement of the employer as far as the defined pension or actually the defined benefit pension plan is concerned, the three items include the net pension cost, the net actuarial gain or losses, and also the net defined benefit obligation all asset as at the start of what of the year. So let's start by computing the first item here. The first item, which will be the net actuarial gain or loss on net defined obligation, net defined benefit obligation. So our figures are in million of shillings. So to compute this, we always start with the net defined benefit obligation at the start of the year, that is balance brought down. So in this question, are we given this net defined benefit obligation at the start of the year? No, this one we are not given. But remember in our previous session, we said that this one is computed by taking what you refer as the present value of the defined benefit obligation at the start of the year minus the fair value of the plan asset as at the start of the year. And this is something we are given in paragraph 1. We are told the present value of the future benefit obligation was 30/80. So to this, we less the fair value of the plan asset at the start of the year, which is 28/60. So that will give us the net defined benefit obligation as at the start of the year. And then to this, we add something called the net interest cost, which is computed on the market yield of high corporate bonds. And we are given that as 5%. So we are going to multiply this with whatever you're going to get there. And then to this, we add the current service cost. The current service cost in our case is given as a figure of 209. To this, we also add the past service cost, if any. And in our case, we have said that whatever you given in addition information number 2, that is the past service cost, which is 110. So here we are going to get the expected present value of defined benefit obligation at the end of the year. And then we compare that now with the net defined benefit obligation balance carried down as given in our question. And in our case, still we don't have this net defined benefit obligation at the end of the year, but take into account we have the present value of the defined benefit obligation and the fair value of the plan asset. Then computation of this is very simple because we are going to take the present value of the benefit obligation at the end of the year, that is 360, minus the fair value of the plan asset at the end of the year, which is 3113. So that will give us the net defined benefit obligation at the end of the year. So let's compute these particular figures. Here we start with the net defined benefit obligation at the start, which is 30/80 minus 28/60. That will give us to 20. And then we compute the net interest cost, which will be 5% of that. 5%, which will give us 11. And then we work out this, which will be 11 plus 220 plus 209 minus, there is something we have omitted here. We need to have, or basically to deduct the contributions. We need to deduct the contributions, the contribution paid to the scheme. So that one is given as a figure of what? That one is given as a figure of 259. 259, that should be deducted here. 259. And then whatever you get here is the expected defined benefit obligation. Okay, so we have taken 11 plus 220 plus 209 plus 110 minus 259, which will give us 291. And then we compare that with whatever you're going to have here. So we have 3360 minus 3113, so which will give us 247. So basically what we need to do is to determine, do we have an increase or a decrease from this figure to this? Is that an increase or a decrease? In our case, that is a decrease. That is a decrease of 44, a decrease of 44. And because this is a variability, that's what we said. Anytime the value of variability reduces, then that is a net actuarial gain. Whenever the value of variability has reduced, that is what? That is a gain. So that is one of the first items which the candidates were required to compute there. The other one is number 2. Number 2 is the net pension cost. The net pension cost, which should be recognized in the income statement. So how do we compute this net pension cost? We add these 3 items. So number 1, we take into account the net interest cost. So the net interest cost is a figure of 11. So we also have, or to this, we add the current service cost, which is 209. And then to this, we add the past service cost, which is a figure of 110. So whatever you get here, we refer to that as the net pension cost, which is recognized then as an expense in the income statement. So this will give us a figure of 330. So that is the other item. And finally, let's compute the other item, which is now the net defined benefit obligation or assets. So we have the net defined benefit obligation stroke assets. Actually, once we get a negative figure here, that is an asset at year end, at year, or basically you can talk of as at 31st of December 2018. So to compute this, we just use 2 items. What we do is that we take the present value of the defined benefit obligation balance carried down. So in our question, this one is given as 3360, and then to this we less the fair value of the plan asset still at the end of the year, and that is given as a figure of 3113. So in this case, if you get a negative figure, that is a net defined benefit obligation, which then is supposed to be recognized as an non-current liability in the statement of financial position. If you get a positive, that is, if you get a positive figure is an obligation, if you get a negative figure is an asset, and that one should be recognized in the statement of financial position as a non-current what? Asset. So what do we have here? 3360 minus 3113, which will give us 247, which is a positive figure, meaning that that is a net defined benefit obligation balance carried down. So this one will be recognized in the statement of financial position of the employer as a non-current what? Liability. So basically that is it, that what was required as far as those 2 questions are concerned, which were testing on the student knowledge regarding how to account for the defined benefit that is the net defined benefit plan, which we said are types of the post-employment benefit plan, whereby the employer promises to pay a certain amount of pension or a fixed amount of pension to the employees by the time they proceed for their normal retirement. So that brings us to the end of that particular topic on employees benefit. So bye for now.